Mark, let's talk about the markets in 3 minutes and start with the banking sector. As I said earlier, just like yesterday, we see overall sentiment not necessarily hugely derailed by this. That's not true all the time, but at this stage of yesterday, that was also the case. We saw a really specific issue in regional banking in the US, and yet futures were higher. Today, futures also higher. Now, we're waiting for the jobs report, of course, but do you get any sense that we're trying to throw a sort of a ring around this, draw a line in the sand around the regional banking story? It just keeps to go on and on.
Yeah, the regional banking story is going to go on and on for a while. As kind of Valerie outlines, guaranteeing deposits may not even end it now. It may ease it, but not end it. And remember, it is weekends where we see banks get bailed out because it's much easier time to kind of manage that process. So I expect there to be pressure on the regional banks again this Friday. But it's really important. This is nowhere near a systemic crisis. This is nothing like 2008, 2009. The US has, I think, still more than 4,000 banks, which is a few thousand too many, arguably. And, you know, despite the fact that it's got these thousands and thousands of banks, we now know that JP Morgan is way too large a share of that banking. Sorry, I shouldn't use the phrase too large. It is a very large share, despite the fact there are thousands of banks. The systemically important banks have different capital rules, different regulations, and they are not under threats. This is not a systemic crisis at all. However, it will have a proper growth impact. Now, the problem is that growth impact will come with a lag. People who are trading the credit contraction to come for the regional banking crisis might be trading it too soon. It is a very, very valid theme, but it might not be something we see for many months yet.
OK, so if we can put that to one side then for the moment, if it does take months to crystallise, Mark, then perhaps we focus much more on the data and we get a jobs report today, we get a CPI reading next week. The way that the market is positioned for a pause and then cuts, it means there's a lot at stake when it comes to these data prints.
Yeah, look, I think the market's a little bit of risk here. The market is completely convinced that the Fed's hiking cycle is over. The Fed is less convinced. They're open, but they've made it very clear they're open, and they've kind of emphasized, hey, look, rates, yeah, might be in restrictive territory, and maybe we need to pause here and see what's going on, but they're open to the idea of hiking again. We know from ADP print that NFP is very likely to surprise higher today. All the jobs data is still pretty strong. Yes, it's cooling, but from exceptionally hot levels. So I think that the jobs data immediately on the horizon might kind of challenge that idea that the US is falling into imminent recession. And I know that labour market is a lagging indicator on the economy, but even claims, which is the most frequent, is not saying we're at recession yet. So we're probably still a couple of months away. But if jobs data doesn't derail it today, we've got inflation next week, and that again might derail it. It'll emphasize that, hey, we're still talking about inflation that's more than twice target. We still have very, very sticky inflation that's not coming down quick enough to justify a complete collapse in yields.